The TEK2day podcast is brought to you by SS&C Technologies, a global market-leading provider of cloud-based investment accounting software services in fund administration. SS&C's AI-powered investment operations and accounting platform, Singularity, provides real-time, multi-basis accounting across a wide range of asset types with unparalleled automation and operational efficiency. Singularity is offered on a software-as-a-service basis or via SmartSource, SS&C's intelligent middle and back office accounting service. For more information, visit ssctech.com/singularity. Welcome to the TEK2day podcast powered by CEO Raider. It's your host, John Maeda. Visit us online at TEK2day.com. We get a lot of content we've put out there in the past couple of weeks since our last audio episode. The market's bounced around a bit, but rather than try to predict where the market's going to go in the next week or two, let's talk about a piece that we wrote that covers the economy. And the title of that article is Credit Spreads Will Widen as Job Losses Mount and Supply Side Costs Increase. What does that all mean? Well, credit spreads, if you're a fixed income investor, you know that's the delta in yields between the risk-free rate and various investment grade bonds and high yield bonds and so forth. And as the perceived market risk, credit risk, grows, the spreads widen. And so we think economic risk is going to grow in the near term for the foreseeable future. So first, you have downward pressure on jobs, and that's going to come from seasonal employment. That's one place it's coming from. And then the other place it's going to come from is companies just tightening their belt. So on the seasonal side, obviously you have the summer employment that winds down between Labor Day and Columbus Day. You also have this year the government effort around the Census. So the busy months there were May, July, May, early August. Now that starts to wind down. You're also going to have, particularly in the absence of fiscal stimulus, which may come with strings attached. I do expect it to come. I'm not sure when. Could be pre-election, could be post-election. But you're also going to have companies tighten their belt because there's a lot of uncertainty out there. Some have already done so, and they just simply won't ramp up hiring. Other companies have a lot more room to tighten, so they'll lay people off. You're starting to see that in the news. You have seen that in the news over the past few weeks. Company A has laid off 10,000 people. Company B has laid off a couple thousand people across different industries. So that'll continue. I think that accelerates. So net, you'll see more company layoffs for the remainder of the calendar year as companies think about 2021. So in the face of uncertainty, companies are going to want to still show a bit of operating profit growth and earnings growth to the extent they're public companies. So you're going to see a general tightening in the corporate sector. So less jobs is one big point. The second big point is you're going to see the cost of goods and services increase. And not because there's massive demand for goods and services, but because of the decoupling with China, which is going to happen whether or not Trump's in office. I think if Trump wins re-election, that decoupling accelerates. I think regardless of whether Trump or Biden win, China will decouple to a degree. They're very strategic, much more so than the U.S., given that leadership is in office much longer than what we have here with U.S. presidents and administrations in Congress. I think China was spooked with Huawei when we threatened to pull back. So they're just building a local ecosystem. Point being that for certain goods and services, we'll have to source those from somewhere other than China. And that somewhere other than China is likely to be a more expensive alternative, thereby increasing the cost of that good or service to American companies and American consumers. So you have companies and consumers being squeezed on one end, the consumer in particular, with job losses. And then you're being squeezed on the other end with a higher cost for goods and services. So what that means is there'll be generally less demand across the U.S. economy. It weakens the economy, probably knocks us back into recession. And of course, the outcome of that, less jobs and higher cost of goods and services, means widening credit spreads for the fixed income markets. Hey, I'm bearish. I've been consistent throughout. We're not through this thing. COVID is going to take a long time to unwind. And that mirage that we had in the summer, where people thought, oh, it's a V recovery. No, it was a bunch of summer employment. And the last thing I'll say is a fiscal stimulus is not going to save the day. It just prolongs the inevitable. If you're a weak company on the last leg of your life, you're eventually going to go out of business, with or without another round of stimulus. If you're a mid-market company and you don't enjoy the same type of profit margins and cash flow generation as a much larger competitor, you're going to lose share as this softness works its way through the economy over the next few years. So it really will pay to be a market leader through this environment. That's all for now. See you next time.